U.S. Recession point, you're concerned that perhaps we might be headed in that direction.
My base case is that we will see a modest recession in 2026. The headwinds for the U.S. economy are just so strong. And the vulnerabilities are that we've only had really two drivers, and they could decelerate in the coming year. Jason Furman, Harvard economics professor, did a study on the first half of 2025 GDP growth. 92% of it, he found, could be attributed to the AI CapEx build-out.
Why the heck is the market tanking? Bitcoin, 98,000. NASDAQ Technologies down over 2%, straight down. Tesla down 7.5%. Disney, earnings? Nobody cares, down 7%. Tech's falling, Bitcoin's falling, it's all falling. What the hell is going on, and how do we reconcile all of this? Is this a buyable dip? Well, to know if it's buyable or even viable to consider buying in this market, you need to understand this chart. It has everything to do with liquidity. Now, remember, before we look at that chart, understand that liquidity is getting so damn bad right now, or available cash, that you literally have articles circulating that the Federal Reserve is saying, quote, the Fed may soon need to expand its balance sheet for liquidity needs. In other words, folks, we are going back to the days of the money printer. Brrr. Now, look, some of what's happening today is super short-termism, but some of it is long-term. AI, data centers, energy, what's going on with Meta, debt. We're going to talk about all of that. But there's also short-termism, and that short-termism is worth talking about to start with. One of the reasons why in the Meet Kevin Alpha report, and I want to teach you this, okay? It's not supposed to be a pitch on the Meet Kevin membership. I want to teach you why we talked about this in the Alpha report. For weeks, I've been saying that the most bearish moment is going to be when the government reopens. And people have said, Kevin, why would that be bearish? The government reopening should be good. Uncertainty goes away, right? Wrong. I'm going to explain exactly why, but this is the kind of stuff you get in the Meet Kevin Alpha report. You pay once, you get lifetime access. Check it out at meetkevin.com. So here's why it works. The government stopped issuing jobs, CPI, retail sales, GDP, import-export data. All of that was gone during the shutdown. When we have no news on that data, we can't say there are problems in the economy. So in other words, the shutdown actually gave us the best trade ever. No news is good news. The stock market hit all-time highs while the government was shut down. It seems backwards, but anything that would have been bad news, we didn't have to see. Now, yesterday, I sold stocks and sent out a trade alert because I said, hey, I'm putting my money where my mouth is. I think we go down when the government reopens. Now, that aligned with Donald Trump saying, America's back, baby, and futures were actually green when the government reopened. But what actually happened this morning? Well, we realized that we're about to get a slew of data. Kevin Hassett came out this morning and told us that the September jobs report has already been cooked. So we already know it's going to come out, aka it's ready for release. It'll probably come out next week. Great, so now we have a jobs catalyst for September next week. Presumably, the October jobs report will follow. The October jobs report is already being asterisked though. It might be so bad, and this is the jaded outlook, but Kevin Hassett tells us that the October jobs report is going to be released without an unemployment rate attached to it, because the unemployment rate will probably skyrocket. Now, part of that could be temporary. In October, we're expecting to see the Doge layoffs from February that would show up in September after their layoffs are over, and then they'd show up as unemployed in October, combined with all the furloughed people. Like, the numbers for October could be really bad, but we're expecting to add all that back in. Goldman Sachs thinks we're going to have a negative 50,000 labor report for October, but a lot of people are just going to adjust that back in. So best case scenario, we have a good September read, bad October, and then a good November again, which will come out in a couple weeks, right? But markets are extremely leveraged. And so now we're going to get a flood of retail sales data, jobs data, inflation data, construction data, import-export data, and it's all going to update this Atlanta Fed real GDP forecast, which says GDP is at 4% in the third quarter, but that's based on a lack of data. So what happens when we get the real data? Well, we either confirm soft landing or we fall into recession. That's where people are today saying, okay, well, how do we reconcile that risk, the pendulum risk, with this chart? Friends, after a lot of work, we figured out how to use a numbers Excel style spreadsheet, and we were able to plot the FINRA margin data on this chart. So yeah, this is from my little spreadsheet. All I did was download FINRA's margin data, and I put a bunch of arrows on it. So it looks really like fancy and like a lot of work went into it. It was probably about 8 minutes of figuring out how the spreadsheet works and about 2 minutes of, oh shit. Anyway, here are the takeaways from this. The blue line is margin debt. The red line is available cash in people's brokerage accounts. Now, what you'll notice is today we have 26% more debt than we had in the 2021 peak over here, which means people are way deeper in margin. And your boy Kevin has been talking about paying off debt, selling assets if you need to pay off debt, getting out of margin, don't trust the big banks. I've been a little bit of a broken record about my fear of margin, and part of it is because of this chart. Since Liberation Day, debt has gone vertical. Now, yes, the chart isn't inflation adjusted, so maybe this is really just similar to this, but even if it's similar, what came after the 2021 peak of margin debt? A nasty year-long crash, okay? This is where The Economist tells us we're actually facing 7 deadly sins. Now, I'm going to talk about that and what's going on in data centers and what's going on with AI valuations, but understand this bottom part of the chart too. Usually, when the market booms and margin goes up, the blue line goes up, cash balances go up as well. 2000 dot-com bubble, margin up, cash balances up. 2006 bubble, cash up, margin up. What's happening now, folks? Quote unquote, this time is different. Uh-oh. Margin up, cash down. We have 26% more debt today on a nominal basis with 21% lower cash available than in 2021. Part of this is because sentiment is like stocks only go up, even though consumer sentiment on consumer spending is crap. Here it is. Consumer sentiment is absolute trash and declining, but household allocations to stocks are skyrocketing. And I think slowly you are getting people that are saying, hey, wait a second here. Are we overvaluing the AI boom? Well, that is now becoming one of the big questions, and it's leading The Economist to talk about the 7 deadly sins that are present in the economy right now. Take a look at the 7 deadly sins, because these are wild and they introduce us to the next parts of the videos, including phantom data centers. Take a look at this, 7 deadly sins of corporate exuberance. We'll keep it simple for us. Number 1, the lust for crypto. Crypto we know doesn't produce underlying earnings, but we love that on one hand because when earnings go down, crypto isn't necessarily associated with earnings going down because there are no earnings, which could be a good thing. Some people see that as a feature. The problem is crypto is also associated with being a risk asset. And when margin and debt are at all-time highs, not only leveraged ETFs, feeder funds like STRC, boy, I've got to make an expose video on that, MicroStrategy feeder funds. We start seeing when leverage gets tight for these funds, the ability to keep pumping up the underlying asset becomes limited. And so while it's really exciting that we've gotten this big movement of corporations going into treasury assets, there's a reason why in my real estate startup, I have refused to quote unquote treasury money into Bitcoin. Not because I don't believe in the innovation of stablecoins or cryptography, but rather because we are a diversified play. People are emailing us saying, hey, I want to diversify. I want to take profits on crypto and stocks. I want to diversify into real estate. And this is like our operating or our fundraising account where over 90% of this is our fundraising over the last period of time here. But I feel like there's an inverse correlation with the more people want to take profits on crypto and stocks, the more our inflows are exploding. And so it's kind of wild that, we're 13 days, even less, I think like 8 banking days into November, and we've raised $1.1 million for a real estate diversification play, with the flair of AI. Read more about that in the offering circular and disclosures at househack.com or reinvest.com. But it's interesting to me because you are seeing that diversification desire. And some of that comes from when we're maxed out on the new total addressable market for crypto, maybe it's time for a little bit of a breather. Then, hey, maybe that creates a buy the dip opportunity, right? Number two, The Economist says the second deadly sin for the economy right now is that retail momentum and this sort of disconnect between fundamentals and realities is a risk factor. And they're not wrong. Elon Musk getting $1 trillion pay package when the stock is trading for like a 6 peg, Palantir with a 7 or 8 peg, price to earnings growth ratio. These are very high valuations, as well as then, of course, stocks that are actually kind of like companies that are losing revenue momentum like American Eagle, pumping on, Sydney Sweeney. But then again, that's not the only thing that pumps when Sydney Sweeney comes on screen. So this is what they call the second deadly sin, retail momentum. Circularity, we've heard this before. The Bloomberg, circular financing argument for NVIDIA and AI has been something we've been kind of complaining about for the last few months here. And it's this idea that, hey, is this circular financing? Or is this really just like no different from GM saying, hey, if you go finance a car with us, we'll give you a discounted rate or whatever on your car, right? Those are the arguments that you have right now. As people say, hey, when NVIDIA backstops CoreWeave, who's going to end up buying more NVIDIA chips, it's really just like financing their ability to buy more chips. But then you kind of run into these problems because I'm looking at CoreWeave's latest sales because I keep looking for their MSA, which is going to come out soon. I'll talk about that in a moment. And what you find is you've got an insider over here dumping $1.4 million worth of shares. This is one of their directors. But then today we had yet another filing, and Westclay Capital dumped $25 million worth of CoreWeave shares. And apparently these are founders' shares. And so it's very interesting because insiders are dumping shares while at the same time, everybody's being told that while debt is at an all-time high, it's okay because don't worry, this cycle of financing will go on forever. But I think this is where companies are getting frustrated. This is kind of like what we talked about yesterday. Yesterday, we talked about how Meta is actually falling off a cliff over here, in part because people are getting frustrated that Mark Zuckerberg might be back to his old ways of drunken sailor spending like what you saw during the days of the metaverse. I hate to say it, but when you zoom out, when Mark Zuck went metaverse crazy, the stock went on this like nearly 1.5 year sell-off, and the stock plunged from almost $400, about 75% to about $87. And so people are worried again that maybe we're in this same environment of overspending on artificial intelligence. And you'll notice that the stock that's not getting hammered is the company that's spending the least money on artificial intelligence. All you have to do is try testing Siri and you'll know that Apple spends basically zero money on artificial intelligence because there is no intelligence. But look at Apple. Apple at all-time highs. Meta is down like 25%. Microsoft is down 10 to 12% off all-time highs. Even Amazon is coming off. You can't see it on the week chart yet, but it's slowly coming down here on the day chart. Is people are concerned about the lack of cash flow at these companies and the amount of debt they're taking on. Amazon just had a quarter that is essentially indistinguishable from no free cash flow. Last year, $2.5 billion of free cash flow in a quarter. This year, $400 million. They're basically next to no free cash flow because they're blowing their money on artificial intelligence build-outs, and people are worried that these companies are going to be bag holders. I mean, the fact that Meta, here's Oracle, it's just a great example. They are way heavily indebted, massive amounts of debt at Oracle. People ask me in the Alpha report, they're like, Kevin, should we buy Oracle on this earnings boom? And I'm like, bro, have you seen their balance sheet? Have you seen how much debt they have?
Kevin is much more interested than most people, by the way, in the balance sheet.
It's bad. And eventually the bill comes due. Now, the issue with Meta is that you actually have a stock that is able to finance the $30 billion build out of a data center by selling the debt to special purpose vehicle investors. And then they don't even have to recognize the lease payments as expenses on their balance sheet as a current or long-term liability for the leases that they're committing to. Why? Oh, because rating firms say you don't have to anymore. That's insane. That's crazy. And it is scary. And it is a red flag that all of a sudden these circular investments are now starting to show up as off-balance sheet debts, even though you're technically having to make the payments for it. That's wild. So you have a liability, but you don't have to disclose it. It's kind of weird. Now, don't get me wrong. I think Meta is one of the cheapest out of the Mag 7 plays. But in a time where the underlying economy is starting to shake, with Verizon eyeing up to 15,000 layoffs, which, by the way, led the stock to actually green candle up, which is another red flag, mind you. Like, you got to think about that. When a stock pops on a day like today, when the Nasdaq's down 2%, 2.2% right now on the Nasdaq, that the Nasdaq's down, it's just like keeps bleeding today. We were bearish in the Alpha report this morning. That's why I sold stock yesterday, because of the government reopening. But anyway, the stock actually popped right here on news of 15,000 layoffs. You should see that as a warning sign. I want you to think about that for a moment. Think about the cycle that happens with layoffs and recessions. This is the scary cycle of layoffs. The way it works is simple. Earnings and revenue go down, so people at companies fire people to increase earnings per share. Revenue's flatline, they can't raise prices anymore because people are pissed about inflation, so you're not getting earnings growth, so what do? You cut in the middle. You fire people so you can get earnings per share up. Then the stock goes up, people are happy, but the problem is that then motivates other companies to fire workers, and then all of a sudden, eventually, you fired so many people that revenues go down, and then you're in a recession. The Economist actually thinks a recession could be really bad for the global economy. They actually say markets could topple the global economy. And what they talk about is not just the Buffett indicator being at all-time highs, but what they also talk about is the fact that so much of the world has exposure to American equities. They say that we're at an all-time high of American household net worth being exposed to the stock market, and international exposure to the American stock market is so high that we could literally create a mini wealth growth effect globally just by having a stock market sell-off in the United States. They say that a stock market sell-off in the United States could cause such a big retrenchment in consumer spending that you could see a 1.6% decline in GDP, enough to push America, where the labor market is already suffering, into recession. Now, everybody's been talking about the potential for a recession, and so far it's been staved off by AI, but that's actually the very problem. Remember that the one thing that's holding up our labor report right now has been, in my opinion, artificial intelligence. I mean, look at the last ADP report, okay? The last ADP report, which has come basically down to zero in part because of immigration. The last ADP report showed that really the only hiring was in the West Coast. 37,000 jobs, in my opinion, likely just AI hires. So what happens when that peg leg of the economy goes away, right? And in fact, that mostly in large employers over here, right? So kind of creepy. So it makes sense what the economy is saying, or what the economist is saying, rather. But the circularity is an issue. These, off-balance sheet financing issues are an issue. It doesn't help that now there's talk that OpenAI is peaking out on growth. It doesn't help that Elon Musk didn't get his Tesla investment into XAI, which I was not an advocate for that anyway. I don't think Tesla should be taking a profitable business and investing into a money-losing business. Elon Musk is rumored to be raising $15 billion more for XAI, which he denies, of course, but whatever. This doesn't help either for the AI plays. Look at this. Phantom data centers muddy forecast for U.S. power needs. They're basically saying that AI companies have these insane views of how much power that we're going to need in the world by the end of the decade, that what happens if we don't actually need that much data or that much power? Well, now all of a sudden, you'll have built data centers or you'll have built power grids that need to be repaid for, but you don't actually have use. And if you don't have that use, then you could actually increase utility rates, making existing AI even more expensive to operate, even more money losing, because now you're paying for an overbuilt ecosystem of power thanks to phantom data centers. You know, they make this quote here: nobody builds a 100-story tower in Manhattan without some anchor tenants. It's kind of crazy. It's kind of crazy to think about just how much is propped up on hope around data centers. Now, hopefully it's fine, right? I'm not here saying we're definitely going to go into recession. I just think we're at a turning point. And when you are at a high leverage point in the economy, you're at high debt. You know, this is why we have zero bank debt at House Hack. This is why Kevin has zero personal debt, is because I'm not here saying I have a crystal ball. I'm going to tell you which way it's going to break. I'm just saying we're going to break in one way. We are very indebted. And the issue is, if we get good jobs data, good, we can soft land. It was a buy the dip opportunity. But if this is a liquidity crush and the Federal Reserve is going to have to go back into money printing mode because we're about to have a liquidity crisis, then you're going to see rates go to zero, the Fed run the money printer, and the economy and stocks could still go down even in the face of money printing. Kind of creepy. I mean, you literally have people worried about the Fed cutting 25 basis points. Oh, is it going to happen in December or not? Who freaking cares? Who cares is the real question. But anyway, look at these other deadly sins. We're not even at them yet. Deal making, number 4, is what they say is the 7th deadly sin. Big boom in deal making, whatever. The debt gluttony, they say, is another big danger for the economy. I mean, that's what we've already been talking about with margin, but it's not just that. It's these off-balance sheet debt plays. Mind you, also what's happening with banks. Like, they make this argument that here there's patriotic pride by JP Morgan saying they will bankroll companies with a $1.5 trillion investment. People misread that headline so badly, and I talked about it when that headline came out last month. I'm like, JP Morgan, I even tweeted it. I'm like, JP Morgan is not going to give you $1.5 trillion of money because it's equity. They're going to lend you money is what they're saying. Oh, we'll lend. Because they said they'd invest like a couple $1 billion or whatever, like 1/100th of what they're saying. But everybody's like, oh my gosh, JP Morgan's so bullish on America. They're going to invest $1.5 trillion in America. No, they're going to lend because they're a bank. That's what they do. And then guess what happens? When banks lend money and then shit hits the fan, they take the money back. They pull credit lines, and that's when things go dirty. Like, we have not even, most people who are in margin right now have not experienced a bank calling you up and saying, hey, guess what? We used to lend you $4 on every $1 of Tesla shares you own. JK, now we're only going to lend you $2 on every $1 of Tesla share you own because, volatility has changed. Oh, great. Well, you know how many people get margin called instantaneously then when you start changing the other? We're not even there yet. We're not even there at the broker-dealers freaking out yet. Broker-dealers are still trying to call up investors on a daily basis going, please take on more debt. Like, please borrow more money so we can pump the fintech space even more. That's what broker-dealers are doing right now. And it's so dangerous for investors because people don't read the terms of services that say these people can rug pull you on margin lines. It's the most scary thing about margin is that they could change the underlying requirements. Economist goes on to say that the United States is now taking stakes. Basically, they're arguing that the United States is misallocating capital by investing in companies like Intel or MP Material or U.S. Steel or whatever. OpenAI is now begging for a government backstop. Yeah, that's a red flag. Yesterday there was talk that the CFO of OpenAI was talking about basically user growth falling in October and turning negative because of changes to, their policies. But what if that doesn't change? What if that growth does stall and there's a cap to how many people want to use a commoditized service like LLMs and the whole, peg leg that supports the economy rolls over? This is why you've got, there's somebody at Goldman Sachs that's arguing 93%, I think it was 93% of earnings that we've seen and earnings growth we've seen is because of AI. Well, what happens when that peg leg goes away? And then, of course, they just talk about greed and fraud, which is exactly what you see at Tricolor, First Brands. They're all pointing the finger at each other going, it's fraud. That's why we're going bankrupt. Not great. And so this is where they say, look at this, Robinhood. They point out that Robinhood has announced that client borrowing has risen by 153% this year. That's insane. That's crazy. So that means if you had, $100 of debt, now you're at like 240 or whatever something dollars of debt. It's insane the amount of money that that people are borrowing right now. So debt, big issue. We already know that. That's why economists are talking about 7 deadly sins. They also have a whole piece here where they talk about, again, the U.S. economy being so vital to the rest of the world that we will probably push low-growth Europe into a recession and China into a big recession. Now, maybe they're just being uber bearish here, right? Usually they say America would be a safe haven and people would invest in the dollar, but you've got problems because are people going to invest in the dollar this time because of tariffs? The protectionist policies that we've had now might not be good. They say, hey, if we do hit a recession, we could not be prepared for these consequences. That there'll not only be even more of a glut of Chinese goods, so more deflation, which is good, but that means even lower earnings for U.S. companies. So something to, I guess start paying attention to maybe a little bit, as well as this Fed liquidity thing. I mean, so far we've seen a relaxation in the repo market, but you get these little fits and starts over here on the repo market. But, even today, Hammock was talking about, we're going to have to inject liquidity again soon into markets. Makes you wonder why. Like, what are they seeing in the background? Who's leaking stuff or data in the background that is making everything turn so freaking red? I personally think it's because people don't have money. So they got to sell to raise capital so they can go buy the dip or whatever. But they got to pay off debt first. And it makes sense. The question then is, which part of this cycle are we on? And again, I realize this is probably not inflation adjusted, right? Like, I'm not trying to be dead bearish here, but I'm certainly not dead bullish either. Again, I'm very teeter-tottery. But it makes you wonder, what happens? Like, when does this margin debt, when do people wake up that debt is very bad at this phase of the cycle? I don't know. Somebody donated last week, and it almost makes me wonder if they're a stockbroker. And not to be jaded here, but I'm going to be a little jaded. They donated $500 on my live stream, and they're like, something to the effect of yeah, margin, baby. And I'm like, bro, the guy just donated $500 on my live stream to promote margin. And I'm like, man, what phase of the cycle is this when brokers or, people are begging you to go deeper into margin? It's really hard, but the challenge right now is being disciplined when everything is kind of mooning, Now, obviously today things aren't, but for me, give me the data, man, and then let's see what the data says. Now, I'm obviously going to take the data with a grain of salt. I mean, you know me, I'm not going to believe all the crap the government is just throwing at our faces. But at least it gives me the opportunity to be prepared. That's why I sent out an alert yesterday to my Alpha Report members and said I'm selling some. I sold over roughly $250,000 of stock, and I've been trimming some positions. I've probably sold $15 for every dollar I've bought in just the last 2 weeks or so. And so you get all those alerts over in the Meet Kevin membership. If you're not part of it yet, I highly encourage checking it out. You get lifetime access, best price guaranteed on the Meet Kevin membership. So you won't see the Meet Kevin membership at a lower price, guaranteed. You get every private live stream, every Alpha Report, all of the courses in one. It's probably a tax write-off as well. And you get the technical analysis every morning in the Alpha Report, for the last 2 weeks, my warning that Tesla's going to go, back down to 414. And, sure enough, it dumps. But, that was, I think, a pretty easy technical call. I'm not trying to minimize the call there. It was a pretty good call nonetheless. But anyway, we'll check that out over at meetkevin.com. And then, of course, if you want to check out House Hack and diversify from the madness, go check out househack.com at, househack.com. And then reinvest.co is what it redirects to. Just to be clear to people, it's the same company. It's just a DBA. And you can learn a little bit about what we're doing, the AI we're building. Big announcements coming for the AI product before Black Friday. So we're really excited about this. But it's pretty cool. But it's all backed by real estate, which I love. And we just bought 11 properties in just this quarter. And what do we have? We got a couple offers out there. I'll see if those go through. So we might be up to a lucky 13 for the quarter, but we'll see. Anyway, yeah.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.